This video is about gamma risk, the new crash-proof way to fix the #1 options trading flaw. Stop losing money when the market drops. Discover the hidden Greek, destroying your trades. If you've ever sold options using spreads, the wheel, iron condors, traditional butterflies, or the 112, only to watch your account get crushed in a market drop, I want you to know something. It's not your fault. That is what everyone is teaching. But there's a silent killer lurking in your account that nobody warned you about. And you're likely obsessed with delta or watching theta decay, but you're ignoring the one Greek that actually blows up accounts. Gamma. Gamma is the speed of movement. Ignoring it works fine in a calm market, but when volatility spikes, gamma turns a manageable loss into a career-ending event. Now, most instructors, they push theory, and I trade with proof. And I've shared my Real P&L on YouTube since 2019 through the 2020 crash, through the 2022 grind down, and every market condition since then. And across all my accounts combined, I've not only been profitable every single year since 2019, I've also outperformed the long-term average return of the S&P 500. Before I show you the fix, you need the foundation. And I'm giving away my Safe Wheel Masterclass. Normally it's $495. I've sold it many times for that, but I'm giving it away for free for a limited time. And it includes the course, the weekly coaching, and my real money trade alerts. Click that link in the description to get in. And today I'm revealing a crash-proof structure backed by data built for volatility and simple enough to follow without guessing direction. Now let's start by answering the big question. How exactly can you sell options and be crash-proof? To understand the solution, you first have to understand why the safe trades are actually dangerous. In this video, I'm going to show you the hidden gamma trap that makes most income strategies structurally fragile. And I'm going to hand you the exact crash-proof 1-2-2 option structure that I use to protect my capital. And I'm going to show you the real P&L proof of how this system handled the last 5 market crashes while the S&P 500 was underwater. Now, you might think high probability means high safety, but here's the truth. High win rate strategies are often designed to fail when you need them the most. Let's look at the short strangle, or the 1-1-2. Here is a short strangle put on. You can see here August 1st, 2024. And you can see what a short strangle looks like. When I look at the gamma, I'm thinking T+0 line, and I'm thinking, how is that curvature of the T+0 line? And this to me is gamma. This is what when I think gamma, I think, how is this line curving, this T+0 line? That's what gamma means to me. This is what a short strangle looks like. Now looking at the 1-1-2, very popular trade, look at the gamma here. Whew, falling off a cliff here. Yeah, it looks like you got some good upside, but wow, look at the gamma risk here. These are what I call gamma traps. They feel great in calm markets because they have high win rates, but they're structurally flawed. And when the market crashes, you have that negative gamma. This means for every point the market drops, your position gets more and more long, and it loses money exponentially faster. It's like trying to survive a hurricane in a beach tent. Most premium selling strategies rely on high win rates, but collapse when volatility spikes. You might start with a 10 delta put, for example, but after a sharp drop, that put becomes 25 or 30 delta. And you aren't just losing money. You're losing the ability to manage the trades because the speed of the loss outpaces your reaction time. But one of the biggest traps I see right now is the 1-1-2 trade. Show you here the 1-1-2 trade here back on the screen. I see it everywhere. It's popular because it has a high win rate in bull markets. You sell 2 naked puts far out of the money to finance a put debit spread. They lure you in with that put debit spread, saying it hedges the downside. But that hedge is tiny compared to the steamroller of the 2 naked puts coming at you. Look at the structure here, and you can see where these 2 naked puts expose you here. Let me go down to the 2 naked puts. This is where your exposure lives. Watch what happens a couple days later. I'm just going to go out a couple days into August 5th. And this trade, trying to make around $725, is down over $10,000. Because look at this T+0 line. Look what happened to it in just 2 days. it drops like a rock with volatility increases. And it has the downside effect of this cliff. This is the 112. This is where you're exposed, those two naked puts. And when the market crashes, that's a massive negative gamma. And as the market drops, your delta spikes. In other words, your direction. When I say delta, I kind of think of direction. Your directional exposure spikes. And you end up holding a massive long position while the market is plummeting. And the trap triggers because the market falls and the position gains more long delta and the speed of losses increase, forcing you to liquidate at the absolute bottom. So if you see here where you're going to liquidate here, this is where you're forced to liquidate because you got to get out. Look, I mean, you don't want to be in here. You don't want to take that risk. This is the psychology toll that nobody talks about. When the VIX explodes from 17 to 60 in 2 days and liquidity dries up and the bid-ask spreads widen. If you look at your 112 or your strangle and you're down months of profit in just hours. Let's look at the strangle here too. I'll go back to the beginning and I'll go into the strangle that I built here with a $2,900 profit target. Look at the gamma here. And if we just go out a couple days, just 2 days later, this thing is down 4,000, 8,000. It's 4,000 one day, 8,000 the next day. Look at this T+0 line, how it just dropped below the break even because of that increase in volatility and the curvature. This is not a good curvature. You want a flat curve, right? You don't want some curve that just, goes one way up, you lose money. If it goes down, you lose money. You aren't managing a trade anymore, right? When this happens, you're praying. And hope is not a strategy. The problem isn't that you didn't predict the crash. The problem is that your structure was designed to fail in a crash. And you need a system that doesn't just survive volatility, but actually benefits from it. Now, the natural reaction is to think, I'll just add a hedge when the market starts to drop. But here's why waiting for the smoke to buy the fire extinguisher guarantees you're going to burn down the house. The fundamental error is waiting. In the options market, hesitation is fatal. Think about it. If your house is on fire and you call the insurance agent screaming for a policy, what happens? They charge you more than what the house is worth. And that is exactly what happens when you try to hedge a position after the crash has started. Let's look at the reactive hedging math. It's brutal. We'll take the 112 and we'll put it back to where it was first put on. And we'll go to the -2. We'll just look at those. As you can see here, the bid-ask spread is 1150 to 1180, nice calm market. You're going to get a great feel, no problems. But what happens 2 days later? Let's take a look at those same puts. Look at the spread, 63 to 68. You think you're going to get, when you try to buy these back, do you think you're going to buy them at 63? No, you're going to buy them at 68. They're not going to sell those to you. Look at the spreads on the other piece of this. Let's widen this out a little bit. 153 to 169. That is not very good liquidity at all. You're trying to get out right now, and your liquidity is absolutely horrible. And these prices are at the mid price. So just think this 10,000 minus 10,000, that's actually a price that you're not even going to get. That's too good of a price. You're not going to get mid price. Now picture this real scenario where the market dropped around 7% in a couple days. Panic sets in. The VIX doesn't just creep up, it spikes from 17 to 60, and you're sitting in a short premium position that's hemorrhaging cash. And you decide you need to buy a put to stop the bleeding. But because of Vega expansion, that put option is now astronomically expensive. And the volatility premium is priced in. And you're buying protection at the absolute top of the market's fear pricing. And if you try to roll your position, it's the same problem. You're buying back your short strikes at inflated prices. And you might save the trade, but the cost wipes out a year of previous income. And you're digging a hole. And this is the emergency repair. And it's why retail traders blow up. You cannot outtrade a structural failure with reactive adjustments. Now, I switch my mentality to just the cost of doing business. In a professional trading operation, we don't treat hedging as a reaction. We treat it as an operating expense. We build the hedge into the trade entry. Why? Because when the market's grinding higher and the VIX is low, protection is cheap and it's on sale. And you're buying the insurance when the sky is blue and nobody believes it'll rain again. And the goal is to create a structure that is long gamma, and in order to move the gamma into your favor when needed. And this means your position actually benefits from the chaos. And when volatility explodes, your hedge must expand faster than your income legs lose money. So let me give you an example of that. This is the 1-2-2 trade. I'm going to get into further details about this later, but you can see how the structure is. Look at the flat, right? T plus zero line, which represents the gamma. The gamma is the curvature of this line. But let's see what happens when this goes through the crash in the same scenario. So let's go 2 days out. One, watch this line. See how it's rising? And two, look at this line. It's rising, see, with the crash. So your gamma is actually helping you with the crash. And look at this, it's actually up money because you're properly hedged and you're hedged before the crash hits. So this effectively solves the cost imbalance. If you buy protection when it's cheap, it's a manageable drag on returns. It's a cost of doing business. And if you buy it when it's expensive, it's a capital destroying event. I trade a structure that solves this equation automatically. I trade a setup where protection is live and working before the first red candle prints. See, I stopped trying to time the market and I started relying on structural integrity. But I didn't just buy random puts that creates a drag. I trade a specific ratio that balances income with crash-proof insurance. So, what is a structure that doesn't just survive a crash, but actually profits from it? The solution is a specific structure I call the 1-2-2 or the PL5 Pro. And it is a modified hedged broken wing butterfly that fixes the structural flaws of strategies that I just went over. So here's the setup. You buy one long put and you sell two short puts, and then this is the key. You buy two long puts further out of the money, and it is a 1-2-2 ratio. And this isn't just a random collection of strikes. It's a finely tuned machine designed to neutralize gamma risk. Let's look at the first structural advantage. You can see here the flat upper line, which means the upside risk is very minimal to almost nothing. In a traditional butterfly or iron condor, if the market rips higher, you often suffer from negative drag. And your T plus zero line, the line showing your profit and loss today, starts to curve down and you lose money as the market rallies. This 1-2-2 is different. I structure the upper long put to flatten the T plus zero line. So that T plus zero line is very flat. And if the market grinds higher for months, like it did in 2021 or early 2024, this trade doesn't bleed. It sits there calm and flat. And I'm not fighting a trend. I've effectively removed the curvature risk on the upside, which is where most hedged strategies fail because the cost of insurance eats you alive during a bull run. Now let's look at the real magic. The long downside runway. And this is where the crash-proof calm comes from. So let's show that again. So looking at that again, you can see here how this runway right here is pretty far before we get that curvature, right? And that's a really good thing. Remember the 1-1-2 trade and the strangle here? When the market drops, they get longer and longer. They get more and more positive delta. They more and more directional, more and more need to go up. They need the market to go up. And this is SPX, of course. And they lose money faster and faster because this curve drops significantly. The 1-2-2 does the opposite because you have those extra long puts at the bottom. You've embedded. Basically, what I've done here is embedded a situation where the gamma morphs into a positive scenario when we get a crash. Think of it as a runway that catches price action. When the market crashes and the velocity picks up, those two long puts, they explode in value. They expand with volatility and what we call long VAMA. And they gain delta faster as your short strikes lose it. Most traders don't understand VAMA, and it is the sensitivity of Vega to change in volatility when the VIX spikes. Standard hedges don't expand fast enough, but the 122's back wings act like a turbocharger for your P&L. The faster the market falls, the stronger the hedges become. There's no panic selling at the bottom. I'm watching my position potentially profit from the destruction. It changes my psychology entirely because I know the math is working for me, not against me. And this is the difference between a structure that breaks under pressure and one that's built for volatility. Managing this trade is not about staring at charts and guessing support levels. It's purely rules based. I use delta adjustments if the market moves. I adjust to keep the structure in line. And I don't overtrade, I don't guess. I follow etched in stone rules. And this removes the emotions. And I'm not asking myself, will the market bounce? What I am asking is, what do the rules say? And then I execute. But again, most instructors, they push theory. I trade with proof. So let's look at the evidence. I tracked my PL5 Pro system. This is my new PL5 Pro 3.0 system, back tested and forward tested, which uses this philosophy against the S&P 500 in an underwater plot from 2015 to 2026. So looking at this underwater plot, you can see the S&P in blue, and you can see the drawdowns here in 2016, for example. The kind of drawdowns, you'd see how wide they are, right? How long they lasted and how deep they got. And then you can compare it to the PL5 Pro 3.0 system. You can see there's some drawdowns here. You can see there's some drawdowns, but not as much as the market. And here, there was some drawdowns here where the market didn't draw down. So that's one exception. But look at the drawdowns here in the COVID crash where the PL5 Pro didn't even draw down at all. And then here, look at the deep and wide drawdowns in 2022, down 25%. It took like 2 years to recover. It's just some slight drawdowns with the PL5 Pro. And again, we had the April of 2025 drawdown where the market was down around 18.9%, the PL5 Pro around 9.79. This chart doesn't just show returns, it shows pain. It measures how deep the drawdowns are and how long it takes to recover. Most people, they focus only on the CAGR, right? The total return. But the underwater plot tells the real story of risk, and it tells you how long your money is held hostage by the market. Now, if you look at the S&P during the Volmageddon of 2018, for example, here, you could see that it was down 8.54, and the PL5 Pro, the 122 structure, 6.27 up. And the COVID crash, where it was down almost 34%, the S&P, and in the same time period, the PL5 Pro 122 structure up 44%. This is over about a 1 month period here. And of course, the relentless grind down of 2022. Here is the grind down of 2022, where the market was down 5.43%, and the PL5 Pro 3.0 up 12.64%. These are back tests. Now look at the PL5 Pro equity curve. When the market crashes, the 122 structure's long gamma kicks in, and the equity curve dips slightly or even stays flat. And then it recovers almost immediately. And again, we can talk about 2022. The equity curve, it dips slightly here or even stays flat and then recovers almost immediately, while the S&P 500 spent 2 years here trying to get back to even. The PL5 Pro system is already making new highs at this point. This stability isn't luck, it's engineering, and I managed the gamma risk before the drop occurred, not after. Safety isn't about predicting the next 10% move. It's about using a structure that handles the move regardless of when it happens. I stopped relying on hope and just reactively panicking. And I started using a proactive structure like the 122. The foundation of this entire philosophy is detailed in my AMP, All Market Profits framework. To learn the core mechanics of this approach for free, click the link in the description and enroll in the Safe Wheel Masterclass right now. And it includes the trade logs, the flow chart, the coaching, and the specific rules that I use every day.